When we talk about the return requirement, first of all, a lot of candidates get confused between the return requirement and the liquidity constraint. The return requirement is to satisfy long-term objectives. The liquidity requirement is used to satisfy short-term objectives. Now, what do we mean by long-term and short-term? Long-term means more than a year, so a year or more. Short-term means a year or less. So if we need to satisfy a requirement in the current year, that's a liquidity constraint. Whereas if we want to save for the child's education 18 years from now, or 12 years from now, or 5 years from now, that's going to be met by the return requirement. So the return requirement, again, is to satisfy longer term, meaning more than a year, objectives. Now, when we talk about the return requirement, we can basically break down the return requirement into quantitative, as you see on my screen, quantitative return requirements, or qualitative return requirements. Everybody always thinks when you say a return requirement that it's got to be a number. 6%, 4%, 3%, outperform LIBOR plus 200 basis points, or outperform the S&P by 200 basis points. That doesn't have to be a quantitative number. So when we talk about quantitative return requirements, let me give you a few examples. One of them would be a absolute requirement. For example, an absolute return requirement would be I need to get a 6% rate of return. Okay, I'm sorry. An example of an absolute return requirement would be, I need to get a 6% rate of return. Okay, it's absolute because it's an absolute number. Okay, so we have what are called absolute and then relative return requirements. So the absolute return requirement would be, for example, a desired return. That would be another example of an absolute return requirement. A desired return, what's a desired return? First of all, desired returns should be ignored. Guy comes to you and says, I want to get a 20% return with no risk. That's a desired return. Everybody wants to get the highest return possible. Nobody wouldn't want the highest return. But are they willing to take the risk that is commensurate with that high level of return? Many people are not, because most investors, we say, are risk averse. So a desired return, and this happened one time on a level 3 exam, and I remember the guy's name, Stevenson. He was a neurosurgeon. He was getting high returns on small cap investments, and he was used to getting 20% returns, and he wanted to continue getting 20% returns. Those are desired returns. They should be most of the time ignored, or you need to explain to the customer or your client that in order to achieve those kinds of returns, they're going to have to up the amount of risk that they take. So for the most part, desired returns can be ignored. The other type of return requirement is what we call a required return requirement. A required return requirement. A required return requirement would be a return requirement that you need in order to satisfy some kind of objective. In other words, you are now in retirement and you've determined that you need a return that will be enough to satisfy your medical payments in retirement. And your medical payments you think are going to be about, you're going to need to get a return of about 5%. So you could say that that's a required return requirement. It is quantitative. It is quantitative. And you need that in order to meet your medical payments as they come due, a return of 5%. Okay. That would be another example of a quantitative return requirement. Another type of return requirement that's quantitative would be a real return versus a nominal return. Again, what's the difference between a real return and a nominal return? A nominal return includes expected inflation. The real return is what we call an adjusted return. So we take the nominal return, we deduct expected inflation, and that gives us our real return. In other words, our purchasing power. For example, when you buy a bond and they tell you that the coupon on that bond is 6%, that is a nominal return. Within that 6% is included expected inflation. So we need to know whether we're looking at a real return or a nominal return. Usually individuals never state their returns in real terms. They state them just in nominal terms. I need, for example, a 5% return. Or as I said to you earlier, a required return of 5%, that would be a nominal return because it includes expected inflation. Once in a while, you could have a client that does need to earn a real return, like a pension plan. They might have their pension benefits indexed to inflation, and they might need a 3% real return. Well, if the client needs a 3% real return, you need to add to that what? Inflation protection to come up with a nominal return. So clients can stipulate their needs in real terms, but then if they do, then the portfolio must also build what is called must also cover inflation, or they must have inflation protection. And the real return plus the inflation protection gives you the nominal return. So again, it all depends on how it's stated by the client. Okay. Another type of return requirement that is quantitative in nature is what we call an after-tax return. Now, individuals are always going to present their returns in after-tax terms because all individuals are subject to taxes. So they want to maximize their after-tax returns. Institutional investors, like endowments, foundations, and even pension plans, they are not always subject to taxes, and as a result, pre-tax returns and after-tax returns don't really matter. So they might state everything in pre-tax terms because pre-tax terms are the same thing as after-tax returns because there's no taxes to be paid. Okay, so again, you want to look at whether we're talking about after-tax returns or pre-tax returns. Okay, those are all what we call examples of quantitative and many times what we call absolute return requirements, where there's a hard number. Okay. Now you can also have what are called relative return requirements. For example, like you want to outperform a specific benchmark. All right. So you want to outperform the LIBOR by 200 basis points, or the S&P by 300 basis points, or you have some kind of percentage that you want to achieve above a certain target. Those are all also what we call sort of relative. You want to outperform the index by a certain amount, relatively speaking. So those are also quantitative, but they're considered to be like relative return requirements. Again, on the exam, don't get so detailed into the minutia. They're not going to say, is this an absolute return requirement or relative? I don't really think so. Just understand the return requirements are qualitative and quantitative. We just went over examples of quantitative return requirements. When it comes to qualitative return requirements, listen, you might sit down with a client and you might say, well, what kind of return are you expecting on your portfolio? And they might say, well, I don't know. I never really thought about that. Well, do you want 5%? Do you want 6%? I don't know. In other words, you can't force a percentage out of them. And if you do, they don't give you one. So what do you do? Well, what you might want to then ask them is, maybe they have some qualitative return requirements. For example, are you looking to get current income from the portfolio? Some clients are just, especially older clients, they're not really interested too much in growing the portfolio. They might just be interested in getting dividends and coupons, current income, so they can meet current expenses. So one example of a qualitative return requirement would be current income. Another one could be, well, they might say, you know what, I'm just going to be happy if we grow the portfolio at the rate of inflation. In other words, we maintain the real value of the investable asset base or the investment portfolio. That would be called capital preservation. Capital preservation is growing the portfolio at the rate of inflation, not above it or below it, but at the rate of inflation. So that $1 million today will also be $1 million a year from now and $1 million 2 years from now, growing at the rate of inflation. Now, usually individuals especially are not really interested in just maintaining the real value of their investable assets. They're looking at some form of current income. They want to get coupons, they want to get dividend income, but they also want to see growth in their portfolio. Growth in the portfolio, that the portfolio grows over time and outpaces inflation, is called capital appreciation. So if inflation is 3%, they want to grow the portfolio at a rate higher than 3%, 4% or 5% or 6%. So that's called, they want to see growth, that's called capital appreciation. Okay? So you can have investors, again, that just want current income. You can have investors that just want to grow the portfolio at the rate of inflation. Or you can have an investor that only wants to grow the portfolio at a rate that outpaces inflation. But many investors, especially younger investors, would like to see some sort of current income and growth combined. The combination of getting current income from dividends and coupons and also seeing some kind of growth in the portfolio outpacing inflation. So the combination of current income and capital appreciation is what we call a total return approach. So a total return approach is a combination of current income and capital appreciation. And later on, and you'll see the formula on your screen already where I show the required return is equal to D1 over P0 plus G. You'll see that formula on that same screen. That's showing you that the required rate of return, which is like a total return, what is the investor looking for? If he wants a return of 10%, he's expecting to get D1 over P0, which is a dividend yield, that's current income, plus G. G is the capital appreciation. So we see that an investor's required rate of return is made up of two components, current income and capital appreciation. Current income from the dividend yield if it's a stock, plus the capital appreciation from the growth of the stock. And that is how we call it the investor's required rate of return for equity. And we're going to be seeing this when we do the dividend discount models in equity later on. Okay? So that is pretty much what you need to know in terms of the return requirement. The second objective is called the risk tolerance. And I said earlier two things. Risk tolerance is an objective, and risk tolerance has to be in sync with the return requirement. Now, when we talk about risk tolerance, we don't just say high, low, or medium. We break the risk tolerance down, especially for individuals, into three components.